Mike, speak to, you know, the people out there that haven't done a refinance that still could take advantage of, you know, the low rates that are out there.
Yeah, I'm actually working on one right now, and it's closing with strategic title.
Yay.
We're saving them $500 a month. So I mean, the opportunity's still out there. This past week, rates actually dipped a little bit again. They're the lowest they've been probably since the election.
Yeah.
So rates are still low. It never hurts just to have the conversation with a lender to see if you can save money. But, you know, refinancing isn't always about lowering your interest rate either. You know, you may elect to go from your 28 years remaining down to a 15-year loan, for instance, and get it paid off a lot quicker. So, you know, there's tons of different options out there.
And sometimes it's tap and cash out. You
Exactly.
know, sometimes somebody's hit a financial rut and maybe they put a lot of money down, or their home is just, you know, really grown in equity, and now it's an opportunity for them to take some of that money, maybe pay for a kid's college. And we're not giving you financial advice, that's your thing.
Right.
Everyone, you know, there's always different needs that people have. You know, Michael, you know, down in Sarasota, for example, obviously, you know, the market, we've talked a lot about this on the show, the market in Sarasota does not mirror the market in Tampa. It is a different real estate market. You can look at the stats and the peak season and see so many variances between the large metropolitan area and then when it drills down into Sarasota or even drills down into Lakewood Ranch.
Yeah, I mean, Aaron and I were just talking about that. It's, you know, it's definitely foreign money investors. There's, you know, secondary homes. I mean, Lakewood Ranch is, you know, very big with primary residences, but, you know, as we were talking about the island and Longboat and the Keys, you know, it's definitely somebody who's buying a second or third or fourth resident. And cash is dipped, but there's still a good 40% of it still cash.
Yeah.
And Mike, what would you say to people out there that are debating between cash or financing? I mean, with money so cheap, I mean, they have, for them to use cash for it to be economical in terms of the best return. And again, there's certainly a personal comfort. Like there's times I buy a property cash that I could go get a loan, but it's just kind of that peace of mind of, you know, just not wanting to have debt. But if you look at the math behind it, there's certainly a segment of the audience that could get a better return with their money elsewhere.
Absolutely. That's something that I talk with clients all the time if they're considering putting down, you know, 20% or 50% or whatever, you know, should I put down more money? I always first tell them it depends on your comfort level with what you want your payment to be, but also to speak with your financial advisor about it because, you know, historically, you're going to gain more with your investments than you are mortgaging a property, for instance. You know, right now with rates still being low, you know, you're going to get more return with that other money, you know, likely. But also, you have your tax advantages as well. You can write off the interest on your mortgage. You know, so a lot of people will finance as much as they can to take advantage of the tax incentives and invest that money elsewhere. So definitely talk to a financial advisor.
Mike, and talk for a minute on the, you know, purchase rates versus, you know, cash out refi rates.
Right.
You know,
Right.
I think that is a good thing to talk
Yeah,
about.
and I think, you know, one of the articles this week, more owners tapping home equity to start businesses. You know,
Right.
kind of knowing what that looks like up front from a rate perspective. You know, refinance, tap out equity, and purchases. What are the, you know, and again, rough, because I know it's going to be
Right.
from
Well,
person to person.
in general, purchase rates are a little bit better than refinances, especially cash out refinances. You know, quarter point, you know, it's typically not much, but kind of the same deal that goes back to, you know, having that tax incentive. I've had people that will refinance before just to drain all their equity, even if they have no need for the money or want it, just to get a higher tax incentive.
They need that boat. Come on now.
Right.
You know, what's you know, kind of on that you know, the same front of tapping out equity and variations of rates. You'll hear a lot. You hear a lot of advertisements. There's different providers that do this. That, you know, no cost refinance. You know, no money down. All that kind of stuff. Obviously, there's no such thing as a free ride. That money's coming from somewhere.
Right. One of my favorites that I always hear is we don't charge any points. You know, points may be an origination fee or a discount point. You get an estimate, and they're charging a $2,500 underwriting fee. So technically, they're not charging points, but they're getting the money somewhere.
Right.
So there, you know, there's a lot of places that do advertise those. There's different ways that they can structure it as well. So, you know, some places will advertise, we'll pay all your closing costs, but they give you a higher interest rate and just give a credit
Yeah,
towards the closing costs.
so it's getting paid for somewhere.
Right.
You know,
Yeah.
and I think that's kind of the, you know, the morality, the moral of the story is that, you know, you hear that advertisement. Yeah, and look, that doesn't mean it's bad. Hey, it might be
Right.
great for you. You're just, it's either gonna be in the rate or fees, or no one's doing it for, out of the goodness of their
Well,
heart.
and I think too, it's, you know, you hear folks that'll go from, you know, a lender to a lender and say, you know, one lender may say, well, based on our overlays, you can't
Right.
get approved for conventional, so we're gonna have to take a FHA. Then you go to the next lender, and based on overlays, they're like, no, you approve for conventional all day long, you
Yeah,
know?
absolutely.
So you hear so much of that, so I think it's.
We've talked about overlays all the time. For those out there listening, what an overlay basically is, you know, FHA, Fannie Mae, Freddie Mac, they all have kind of their own guidelines that say this. But lenders, because of their own risk tolerance and them not wanting to buy back certain loans, put their own on top, their own terms or guidelines on top of that. And sometimes you'll hear someone say, you know, like an example is someone will say, and I completely lost my train of thought.
Well, I was
You
gonna say,
can't
I-
take 6
I got interrupted by a text message.
Yeah, I was saying,
I got
I
interrupted by a
think
text
so.
message from
I
Lewis on
think-
our real estate team.
An easy one right now, you know, Fannie Mae just recently changed their debt-to-income ratios from 45 to 50%.
Yeah.
You know, a
They
lending
may say-
institution could still have that overlay that,
Right.
you know,
And the
yes,
lender
it's
will say,
allowable,
oh,
but
you
we're
got
not doing it.
declined, or Fannie declined you, when in reality it wasn't that.
Yeah, I tell people that all the time. Just because you're declined somewhere doesn't mean you can't get a loan somewhere else. And I do the same thing. You know, hey, I can't do this, but you know, here's someone that might be able to help you out.
Yeah, and I think, again, the overlays get confusing for customers. The reality is, and I think the simplest way to think about this is, just because one lender says no doesn't mean every lender is going to say no.
Exactly.
Just because one lender says yes doesn't mean other lenders are going to say
Right.
yes. You know, especially if you're in that kind of buffer area where your rates are, your numbers are really tight, your scores are really tight. So